As we head toward the end of 2025, the king of dividend growth ETFs, SCHD, continues to lag behind many of its competitors in share price. Most notably, their closest rival, which is Vanguard's VIG, has seen significantly more share price appreciation in the latter 6 months of this year. This has also been the case for ticker DGRO, which is the iShares dividend growth ETF. The two of these funds have been neck and neck with each other, while the Schwab ETF has been failing to keep up with both of them. Finally, it's also been a similar situation for ticker VYM, which is Vanguard's high-yield ETF. This one has also been experiencing more share price appreciation than SCHD for the majority of the year. I've talked to a lot of investors who sound frustrated by SCHD's underperformance in the last 6 months of this year. And I've regularly been getting questions from investors asking if they think now is a good time to sell out of SCHD for VIG or any of the other better performing dividend growth funds. And to answer that question, I would say it honestly depends. It's going to depend on what your goal is and also what your time horizon is. So in today's video, we're going to take a look at SCHD right now and just check in on the health of this fund and see why it might be a good idea to sell out of it for certain people. But then we'll also look at why it is worth holding on to for certain investors as well. So what exactly is SCHD's problem? Why has it been lagging so far behind most of the other dividend growth ETFs in the latter half of 2025? The underperformance problem started around the time they had their annual reconstitution. This takes place once a year when SCHD will eliminate some holdings and replace them with others. The way they do this is described in their prospectus. The fund invests in stocks that are included in the Dow Jones U.S. Dividend 100 Index. Stocks that make up this index must have sustained at least 10 consecutive years of dividend payments, have a minimum float-adjusted market capitalization of 500 million USD, and meet minimum liquidity criteria. This index does not include REITs, master limited partnerships, preferred stocks, or any of the alternative investments. Once screened, the index components are then selected by evaluating the highest dividend-yielding stocks based on 4 fundamental base characteristics. That would be cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on a modified market capitalization approach. No single stock can represent more than 4% of the index and no single sector. So that's how SCHD's holdings are selected. During that last reconstitution that took place, there was one sector that had more eligible stocks out there than any other sector: energy. We can see that more energy holdings were added to this ETF than any other sector, including consumer staples and materials. Now, energy stocks are really good companies when it comes to dividends. Most utility companies in general will pay above average dividends because they aren't fast growers when compared to tech or financials. So to make up for all of that lack in growth, these companies regularly dish out huge dividends in order to attract investors. The issue, though, is that the market has been shunning energy stocks for the majority of this year. If we look at the Vanguard Energy Index Fund ETF, which has the ticker VDE, we can see energy has been lagging behind a lot since April. SCHD's reconstitution took place in March, right before the energy stock plunge that took place. So that's the main reason. The energy sector is why SCHD has fallen so far behind and is lagging in recovering. It was honestly one of the worst times possible to go this heavy into energy stocks. Roughly 20% of this fund is made up of energy companies versus just 2% for VIG and 5% for DGRO. Now, if you are bearish, if you think the market is going to take a downturn, then that's usually when people pile into energy stocks because they're much more stable. So that could be a reason to remain in SCHD, which is if you have a bearish outlook. When the markets take a downturn, then it's very common for people to load up on energy stocks because people are still going to need electricity regardless. But SCHD also holds a lot of dividend aristocrats, which are companies that have grown their dividends for at least 25 consecutive years. In fact, if we compare SCHD to a dividend aristocrat fund like the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBLE, we can see their share prices move almost identical to each other. So the companies inside of SCHD do have good cash flow to support their distributions. There isn't any kind of risk of a large dividend cut that I'm seeing with these holdings. But let's focus on the dividends specifically and not the share prices. When compared to every other dividend growth ETF out there, including VIG and DGRO, SCHD has the highest amount of dividend growth. According to Seeking Alpha, their 5-year dividend growth rate is 10.38%, and it's been over 10% very consistently. VIG appears to be the second best. Their 5-year dividend growth rate is 9.73%, which is likely the highest I've seen it. So SCHD has faster dividend growth, but it also has a higher current yield. The Schwab ETF currently comes with a yield of roughly 3.8%. VIG's current yield is only about 1.6%. So you're getting more than double the money for every dollar you invest right now. You're getting a yield that's more than twice as high and faster dividend growth with SCHD. So with that in mind, let's go ahead and run some numbers and see what kind of results we can expect from holding both positions for the long term. For this example, we'll invest $10,000 into SCHD and $10,000 into VIG and hold both for 20 years. For the Vanguard ETF, it'll be $10,000 invested today in an ETF that yields 1.61%, has 9.73% dividend growth, and increases in share price by 11.96% per year. That's the average amount of share price appreciation VIG has experienced over the past 5 years according to Google, which is higher than typical. We'll also assume that you reinvested the dividends, and again that you hold on to VIG for 20 years. According to Google, after 20 years, a $10,000 investment in VIG today would pay you $1,372 per year in dividends in year 20. Now let's take that same example using SCHD. We'll say $10,000 in this fund for 20 years, which yields 3.8%, has 10.38% dividend growth, and increases in share price by 6.54% every year. That's the 5-year average for SCHD according to Google, and again, reinvesting the dividends. We can see according to Google, your yearly income for this ETF will be $5,520 in 20 years. That's more than 4 times as much future income from SCHD compared to VIG. You're starting with a much higher yield and faster dividend growth. So with that in mind, here's how to think about SCHD's underperformance in my opinion. You can't lose with either VIG or SCHD. If you'd prefer selling SCHD for VIG or DGRO or something similar, you'll still do well over the long term no matter what. If you have a long time horizon, then your dividends are going to compound faster with SCHD. But depending on the economy, energy could still lag behind for some time. I still think bearish investors would be better off with SCHD, but VIG would make better sense if we remain in a bull market. We've actually been seeing that play out over the past few days. The markets have been falling this past week, but energy is up. But those who are still economically bullish until SCHD reconstitutes again early next year and want to capture some more upside will likely do better with VIG. But for those of us remaining in SCHD, the best advice I could give you is to simply just be patient and enjoy those higher dividends. And with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.